Well, despite record levels of storage, natural gas has rebounded sharply from lows earlier this month. It is up 57% since just September 3rd. Here's Bloomberg's commodity reporter Michael Whitney with the story. Nat gas, the theme of the last couple of days for sure.
It certainly has bounced. It's made an impressive run. I mean, just 3 weeks ago, you were talking about the bounce, 57% in 3 weeks. It was trading $250 just a few weeks ago. It's bounced sharply, and it's caught a lot of people off guard. And this is despite a very sloppy fundamental picture. You're talking about big storage levels. This just means there's a lot of natural gas around to heat people's homes in the winter. Natural gas storage levels are at historic levels. Lots of gas around.
You were schooling me the other day explaining that this was short covering, though, that's going on in natural gas.
Well, that's exactly what's happening. There have been a couple of fundamental factors.
Right?
There you go. And the purple jacket goes well with you.
Thank you.
Well,
I threw you off. Now you're speechless.
No. Well, in terms of short covering, there are a couple of big fundamental events that happened. There was a winter forecast. The climatological forecast looked much colder than people thought. We saw the guys that were betting on more storage weighing down prices. Well, we had cold winter forecast. People ran to the exits. There also was some switching. Nuclear plants were down. We had some coal switching. People that usually burn coal to make energy, well, they were burning natural gas instead. And the low prices actually stimulate a little bit of demand, and that's a pretty common thing in the commodity world. We also have seen pretty widespread regulatory fear, and this is what we're going to talk to John Hyland about here coming up. There's been a lot of fear that the CFTC is going to come in and regulate the space in such a way that people are getting out of their positions. Most of the people in natural gas, they were short. They're worried about position limits, which is how big a size of position they can carry. They've been covering those positions, buying back their shorts.
Well, Michael, let's bring John Hyland in right now, the Chief Investment Officer with the U.S. Commodity Funds. Welcome to you, John.
Thank you, Lori.
So what do you think about what Michael is describing here about the CFTC claims that ETFs like yours are contributing to higher prices in energy markets?
Well, I'm not sure if that's exactly what the CFTC is claiming. Quite clearly, you had a lot of people making unsubstantiated claims in 2008 and earlier this year, blaming last year's run-up in crude oil and natural gas prices on the ETFs. The actual data came out from ourselves and others quite clearly showing that we were not net buyers during this big run-up, completely destroying the argument that you can lay the blame for these high prices at the foot of commodity ETFs. I'm not exactly sure that the commissioners at the CFTC believe that we're the responsible party. They believe something else. They believe that they need to have additional regulation. They believe they need to have additional information about these markets. I agree with the second part. I'm not sure that there's a case to be made that these position limits that they're talking about are desirable or will lead to the outcome that they're hoping for.
John, why do you think they've singled out the exchange-traded funds, and why not, say, other people that speculate in these markets, whether that be big macro hedge funds or just the oil companies themselves? It seems that they've put an inordinate focus on exchange-traded funds, which are just retail investors trying to get exposure to the space.
I think it does come back to 2008 and the big run-up, and in the aftermath of that, you had a lot of people casting around for who was going to be the villain to be tarred with this outcome. Traditionally, we've always, if gasoline went to $4 a gallon, you'd say it must be OPEC or it must be Chevron or Exxon. This time around, we had a lot of bloggers and politicians saying it must be those commodity ETFs, despite the data goes the other way. I think the CFTC got caught up a little bit in what I would describe as the economic lunatic fringe. People throwing out these accusations without the slightest bit of data. And the other part of it is, in one sense, we're an easy target. We're public. We tell people what we're doing. People can see it. It's very difficult to see what's going on in Saudi Arabia or with large oil companies or with large hedge funds or with China. But we're easy. So I think we're an easy target, if nothing else.
So, John, is it your sense that they're just looking to be seen as doing something as opposed to really focusing on what might actually be the problem?
If they're real, well, I'm not sure what the problem is. Is the problem that last year, in an unusual set of circumstances, crude oil prices and natural gas and many other commodities reached record levels? Is that the problem? If that's the problem, the proposed regulation won't address it. Is the problem volatility? The proposed legislation, if it's going to restrict the ability of financial investors to take positions, is just going to lead to a decline in liquidity and an increase in volatility.
Do you
so I'm
think
not
that
exactly
any
sure
form
what the
of
problem
regulation
is.
then is needed in commodities trading?
I think what the CFTC desperately needs is better tools to measure what goes on, both on the listed side, where I think the tools are quite good, but also on the over-the-counter side. That is not something traditionally they've had. We would be a big supporter of their having better tools, but right now, they haven't shown the data that makes the case that the kind of regulation that people are speculating that they're going to bring out is going to be beneficial. Most of what we've seen, most of the people who are experts in this area and are, believe that it will actually make things worse.
So, John, what would happen to USO and UNG if they did impose these limits on position size and got rid of the swap loophole? What would you guys do? Would you go overseas like a lot of funds are looking to do and invest in foreign commodity markets?
Well, assuming that you bring in new limitations, and the limitations go above and beyond just putting a very hard cap on how many listed futures contracts you can hold, and does in fact deal with total return swaps and these other things. Certainly one possibility is to see what else would be remaining in the United States or outside the United States that would allow me to purchase on behalf of my shareholders the kind of exposure that they're seeking. But there is a scenario that says if that's not possible, that we might actually have to be forced to be in a position to reduce the size of the fund and return some portion of the cash back to our shareholders. That doesn't mean UNG goes out of business, but it could be that we'd have to hand back some amount of the money to our shareholders. Now, the problem there is the shareholders are in UNG because they want the exposure. So if I'm limiting their ability to own UNG, presumably they'll just go find another natural gas vehicle, another natural gas ETF or ETN that allows them to have exposure that way. So in that sense, it doesn't really change how much interest people have.
Mr. Hyland,
it just forces them into progressively smaller pieces.
And it doesn't bend for anybody. Back with more after this.